Hey, everybody, Joshua Phillips here, Churchill Mortgage coming to you with another Friday market update. Today is October the 11th. Now, unfortunately, I wasn't able to do a market update last Friday, so this was going to cover 2 weeks. And I'm going to go ahead and give you the headline. Mortgage rates have not done well the last 2 to 3 weeks. So we'll go ahead and just put that news out there. Now, why exactly is that? That's, of course, the big questions. As we saw mortgage rates hit their best levels in quite a long time back on September 17th when the Fed cut the Fed fund rate. I think I said in my last market update that this idea of kind of buy the rumor, sell the news, which is something you hear about in the stock market. And I think that's a little bit of what's happening. And then secondly, it's kind of like the sugar high right there. And then it's like things have fallen off since then. Now, a lot of it has to do with the fact that the market's always anticipating what's coming next. We said for a long time that when the Fed cut the Fed fund rate 50 basis points, that was already baked into the market. It's already what the market had been thinking. So as we look ahead, we were anticipating maybe the Fed cutting the Fed fund rate another 50 basis points in November and maybe again in December. However, we've been getting some really strong information, as you see here on the screen. This was last Friday. It says September's shockingly good jobs report changes everything. That was a headline on CNBC. I always like to pull up a headline from CNBC. We've been getting good news, talk of a soft landing. And so maybe that means that the Fed's not going to have to cut as aggressively or as much. Now, I'm saying a lot of information here, but I will say that the Fed fund rate is not mortgage rates, but they are related to each other. And so when the Fed seems to now be saying, okay, maybe we don't need to cut so much so fast, that's just affected what we thought was going to be happening with mortgage rates. Now let's flip over here to mortgage-backed security chart. If you've watched these for any amount of time, I always like to say that any professional loan officer in America has this screen up all the time as we're watching what's happening with mortgage-backed securities, which is where mortgage rates most directly drive their value. All you really need to know to understand this chart is pretty simple, is green is good, red is bad, and the higher the security price, the better mortgage rates are doing. And you can clearly see we've been on a great path, better, better, better. And then right here, right about September the 17th, 16th, 17th, we actually hit our peak. And what's happened since then? A lot more red than green. We've seen the price of securities fall off. This big candlestick right here was last Friday with the good jobs number. And now we're just kind of hanging out. I'll also point out this idea I've been talking about of this 25-day moving average. We wanted to stay above the 25-day moving average because that was our support. And we did. We were kind of hanging in there until about the end of the month. And then here we've kind of, now we've like fallen off. What this means is that mortgage rates have fallen off at least a quarter to perhaps as much as 0.5% in the last 3 or 4 weeks. I should have learned my lesson that you can't really ever predict what's going to happen with mortgage rates. I really felt like we were going to be on just a slow improvement. But surprise, surprise, as the market often does, we have fallen off. Now, I personally don't think all hope is lost. I really think we're going to hit some level of support and we'll see rates hopefully start to slowly improve again. It all depends on economic reports. Maybe the results of the election, who knows? But I still think that the outlook is positive for mortgage rates. Now, for anyone that was looking, I've got a lot of clients that I'm emailing this to who are, perhaps wanting to refinance in the future, and we'd love to be able to facilitate that. But I would say what we're going to be looking for now is when we get back to that September 17th level, we get up here. At that level or better, maybe that's when we start thinking about locking an interest rate when we get back to that. So who knows if that's days, weeks, or months away, but that's probably a good target to go. That was the top of the market for the last couple of years. So if we can get back to that level, again, maybe a quarter, 3/8, perhaps 0.5% better in interest rate from where we are today, that would be my signal to maybe say, hey, let's really look at locking things in. I'll point out one other thing. That's just a nerdy thing right here. This is called a stochastic chart. Look it up. Stochastic right there. If it's really high, it means we're overbought and we're due a correction. And now we're oversold, means we're due a improvement. So, I mean, we are down here and we are due some improvement. We're oversold right now on the stochastic charts. Again, feel free to Google or ChatGPT this information. Well, rates are still better than they were a year ago. I mean, a year ago we were over 8%. Now we're, for most people, we're going to be in the sixes. And so rates are still reasonably good, reasonably better than we were. So while we've kind of fallen off that positive trend, we're still pretty good. And I think there's a lot of reasons to feel positive about things. So feel free to reach out to me if you want to talk about your specific situation and interest rate. If you want to get pre-approved, please feel free to go ahead and fill out an application. I am always here to help. Take care. Bye-bye.